I'm going to start today with three numbers, 3.5, 9, and 22. 3.5 was global growth in 2018. 9 is the level of the VIX today, and 22 is what the S&P 500 returned in 2018. You probably think all that is totally unremarkable. The reality is it's totally remarkable. 3.5% global growth, highest since 2011. 9 on the VIX is the lowest since the early 1990s. 22% on the S&P is not to be sniffed at, particularly because it did 10% the year before. So our sense is that as night follows day, nemesis follows hubris. And one of the central points we'll be making that's come across already is there is a huge amount of complacency when you look at markets. You all know the story of Daedalus and Icarus. They're fleeing from Crete on the way to Sicily. They build their wings. Daedalus says to his young son Icarus, steer a middle course. Don't get greedy. You go too close to the sun, the wax melts. You go too close to the sea, the water gets you. And what happens? They have a successful escape. Icarus goes far too close to the sun. He gets complacent. And our view is that we're at a critical juncture now in terms actually of a very, very big regime change when you look at the global economy, which will have, our sense, very big implications when you look at financial markets. So just to explore that over the next few minutes, I thought I'd split this into three. We'd start with a history lesson, and then we'll get on to 5 fairly common myths. And then I'll wrap up with what we at least regard as the bond manager's survival guide for the new era that we're going into. But we'll start with the history lesson. As you've gathered, I am a little bit of a historian, and these are UK interest rates going back over 300 years. And when you look at this picture, it serves to remind us that where we are now is totally and utterly abnormal. And when we look forward, we think that this will be seen to be totally unusual, it's unprecedented, and it will change. What I took from James's presentation at the start was also the market actually is hugely complacent in terms of what's priced in the way of central bank activity. So why now? Because the reality is you could have looked at that chart over recent years and made a very similar observation. But ultimately, if you think about markets, they move in regimes, and sometimes greater or lesser extent, but give or take, they're about a decade, those regimes that we have. So think back to the early 1990s, and economic policy then, really throughout the world, made way for the nice decade. That was Mervyn King's phrase of non-inflationary, consistently expansionary. That gives way then to a financial crisis, 2 or 3 years duration, and we've had about, give or take, 10 years of, in inverted commas, deleveraging so far. When the history books are written, our view is that 2017 will be seen as a transition year. As you look forward, 2018 will be seen as the year of regime change. And what it comes back to is actually central banks. And that, I think, is where the polling question was so interesting. I'm in the Jeremy camp. I look at the potential risk actually very much coming from what a lot of central banks may do in terms of increasing monetary policy. We forget, but already the Fed's raised rates 5 times. If James is right, we'd agree with it. They go another 4 times this year, and then 3 times next year. You're looking at something like 12 hikes. The market's not prepared for that. So our sense this year is very critical. As you get to these turning points, this is where myths go. And what's seen as things that are very, very unthinkable actually become very, very thinkable. And it's always surprising the speed with which markets can move. We think these are 5 very common myths where there's actually a huge amount of complacency. And let's be honest, it's very easy to be complacent now. The sun's shining, virtually every financial market's going up. In some bits of financial markets, we've never had it so good. So this is the year to be alert. It's the year when a lot of these myths actually may be very much challenged. And the first of those is inflation's dead. And I see this as a bond investor. When I chat to my bond team, they hunt around the world, and maybe it's self-fulfilling, but they can't really find signs of inflationary pressures. The reality is, though, take a closer look in terms of inflation. Look on the left-hand side in terms of short-run measures of inflation. They've started to pick up. If you look at 3-month trailing indices, that's US data, very similar actually when you look in the Eurozone. Even in Japan, inflation surprising to the upside. And then the really interesting one, though, is the right-hand side. And what that looks at is investment spend. And when you look at investment spend in 2017, it shot up like a rocket. And there's a number of what-ifs now, but typically what happens is that you get investment spend going up. As investment spend goes up, you get productivity gains. As you get productivity gains, of course, you can then get wage growth. So a number of steps there. It may not happen this time, but typically it does. And again, think when you take a step back about the broader perspective of generationally low unemployment rates, maybe this is the year that actually inflation surprises to the upside. How do you trade that? We've said already, we're in the camp of James. We look at financial markets. We think they hugely underestimate the potential for rate rises. And the reality is you look at the Fed, the market's pricing a couple of rate hikes. And I think he said this, if they go 2 or 3 or 4 times, in a sense, so what? We know the direction. The really big one is Europe. When you look at Europe, the market's pricing the first rate hike at the end of 2019. That's absurd. When you look at the policy setting in Europe, a policy rate of -40 is set for an emergency. Is Europe in an emergency? Not when we look at the economic data we've just seen. Europe's the international economic success story. Can the market price rate hikes this year, even if they're not delivered? Absolutely. Remember the speed with which financial markets can shift. And then you look at the percentage of negative yielding bonds, call it a third, you can see where one of the pain trades in markets is. So the second risk is political risk. And I don't want to be dismissive here, but when you add up the number of elections around the world, including regional elections, you get to something like 84 this year. So on average, you've got an election somewhere around the world every 4.3 days. Clearly not all those 84 matter. Maybe 10 or 15 of those elections actually matter for markets. The point is, there's a lot of them. We're used to them. It creates great press coverage. But ultimately, what's the impact on markets? And what's the impact in terms of growth and inflationary pressures? Often a lot less than you think. And Europe's been in the eye of the storm recently. Actually, when you look at perceptions of the euro and whether people like it or not, in virtually every European country, including Italy, support has gone up, which again brings you back to the economics. If people are doing well, if they've got jobs, they're getting wage increases, they're generally happy with the status quo. So how do you trade this? A couple of ideas here. The first actually is Italy. When you look at Italy versus Germany, the 10-year spread today around 150 basis points. There is no reason this year that spread can't halve to 75 basis points. Again, it sounds ultra ambitious. With good eyesight, you see on that chart, that takes the spread back to 2015 levels. And again, I thought great charts coming from the first presentation from James. Look at some of the indicators of economic health in the Eurozone. Look at the number of upgrades versus downgrades. You've got a fundamental picture that supports that. And then I think the other one is Brexit. Like everyone else, I've no idea how the negotiations there go. What I do know is that deadlines come and go. And if the probability of no deal is only 30%, from a risk-reward, I'd take the other side of that. And I think the pain trade with something like sterling is that actually appreciates over the course of this year. The third common pushback we get, certainly as a fixed income person, relates to credit. And there's a hugely consensus view when you look at corporate bonds that actually the party's over. Corporate bond returns have been too strong, and when you look at those returns, they're bound to falter. Again, we take the other side of that. When you look at a lot of the operating metrics for corporations, they look robust. And if anything, with an improving global backdrop, those operating fundamentals are likely to get better, not worse. The risk here is we slip into a recessionary environment. The other risk actually as well is that companies really misallocate capital. Because if companies misallocate capital, at least the debt holder hates it, because they typically favor the equity holder over the debt holder. So the forward-looking indicator is to look at the use of proceeds. When companies issue debt, what do they do with that cash? And this is data for US high yield, but it's fairly representative. When you look at 2017, something like 2/3 of all debt issuance was used to repay existing debt. You'll notice that 2/3 figure is high. You go back to pre-financial crisis, it's around 1/3. You go back more recently to a terrible year for credit markets, 2015, again it was 1/3, with the rest of the cash being used to keep the equity holder happy. Stock buybacks, dividend increases, etc., etc. So this, in fairness, is one to watch. M&A activity's gone up, but at the moment, this again is very supportive when you look actually for credit conditions. So where can some of these spreads trade to? Certainly if you look at investment grade spreads, call them 100 now, 80 is a reasonable target there. And then I think the more interesting one still is high yield. When you look at the spread there, 4%. What's that 4% representing? A default rate. Trailing default rates, 1.5%, something like that. Our view is they probably remain very, very low. So the all-time tight in high yield spreads is 2.25. Are we going back there? Probably not. Can that spread go from 4% to 3%? Why not? If you've got sensible use of proceeds and a very, very low probability of recession. I think the other common myth that will be dispelled this year is around emerging markets. And I think we're all guilty of this. we lump developed markets together and emerging markets. And categorically, when you look at emerging markets, they are not all equal. And when you look at the dispersion between emerging markets, it's never, ever been greater. You saw that in returns in 2017. Look at the top performing versus the bottom performing. The other interesting dynamic there is whether you're a euro or dollar-based investor. And clearly a lot of the returns in 2017 were down to dollar depreciation. When you look at emerging markets today, the average local emerging market yields 6%. The highest yield there is 16.5%. The lowest actually is Hungary at 1%. So the message when you look at emerging markets is that discrimination actually will be key. And that will impact a lot of the price performance. I'm glad I put in Indonesia, hearing earlier that Fitch had upgraded Indonesia. We agree with that. These are just two ideas that we like right now. In terms of local emerging markets, Indonesian debt, 6.5%, 7% in terms of yields. When you look at somewhere like Brazil, and again, I was heartened to hear the comments earlier from Brian in terms of stronger growth this year and debt to GDP coming down, because you're getting 12% there. Implicit in that is a view that the dollar probably depreciates. We'd subscribe to that. I think a realistic target when you look at euro dollar at year end, something like 130, 135. Again, sounds aggressive. To get that, we'll need a change in the ECB reaction function. Even if we're wrong, you've still got a decent running yield when you look at a lot of these emerging markets. Then the final myth actually brings me home back to fixed income. And there is a very common perception fixed income is about the income. The clue's in the name. That used to be true. When you go back over the decades, fixed income yields were high. You had many government bonds with a 7% yield. 7%'s that magic number. You have 7% yields or returns for 10 years, you double your money. When you look at it today, though, we're in a completely different world. And I think back to that long-run chart of Bank of England yields. And the reality is your income from fixed income is likely to be significantly lower. And when you think of fixed income going forward, it's going to be a market where you're going to have to try and generate capital gain or indeed avoid capital loss. It will be a much more idiosyncratic market. Two companies you're all familiar with. You look back at the performance in 2017, Tesco, both high-yield companies. Tesco had a very strong year. Our sense is at some point it will be promoted back to investment grade. And then the other side of the UK high street, you look at New Look. So this shows that you need security selection. It shows the perils also of just buying high-yield bonds. Just because a bond has a high yield doesn't mean that yield can't go higher. So there are 5 myths we think that will be shed this year. And how do you deal with that? And this is really part 3 in terms of this idea of a survival guide. And the first part of that is that I said earlier that we've been in a deleveraging cycle. You all know we've not really. When you look at the size of global debt markets, they've kept getting bigger and bigger. And therein lies a risk, but also a huge opportunity. Add up every bond in the world, you get to something like 100 trillion US dollars. That's a market something like 2 or 3 times the size of the global equity market. And that's critical. Think back to what we all learn, what we all preach. What you need is a big opportunity set. If you have a big opportunity set, you can get diversification. If you get diversification, you can get higher rewards for lower risks taken. That's what rating agencies teach us, isn't it? They always look for the risks and try and manage them. So you've got a great big opportunity set. And when you think of some of the developments of bond markets, those markets on the left are probably half of that 100 trillion. The markets on the right, some of them much, much newer, again, probably another 50 trillion. As you go from left to right there, what happens is typically yields go up. You've got a bit more risk, times a lot of credit risk. But look at the correlation. The correlation there is to treasuries or bonds or gilts. It typically goes down. So you can see here you're unlocking the key to something interesting. Big opportunity set. You get your diversification, potentially higher rewards for lower risk taken. So in terms of surviving this year, these are 5 ideas we've got. We've touched on some of these already. You'll need to be in these at different times of the year. Each of these, we think, can return you 5% when you look in terms of returns this year. Some of those will be the yield. High yield will be one. Some of those will be taking a bit of currency risk. You look at emerging markets. The final one, actually, our view will be a capital gain. When you look at a lot of those negative yielding European bonds, particularly in Germany, we think the risk there is they go a fair bit higher. So in the spirit of risk, I will end on this slide. You've heard our view when we look out. In the spirit of nemesis following hubris, we're quite happy to be wrong this year. What's on our watch list? The first is growth. And we've heard it many times already this morning. Growth is great everywhere. What if it's not? We think it is, but I think that's a risk to be alert to. What could cause that is as central banks remove monetary policy accommodation. Inflation, we don't think happens, but may get worse than better. What if developed economies follow that classic Japanese roadmap and go from low inflation back into deflation? It's a risk. And then from a purely fixed income perspective, there has been a huge amount of money going in to fixed income markets. A lot of that provided by central banks. I go back to the key risk that was the polling question at the end of James's session, and maybe markets underestimate that. I think the point is to be aware of complacency, to be aware that nemesis often follows hubris, and then to guard against that. Thank you for listening.